Welcome, everybody, to the What's the Deal with Deals live broadcast. We're broadcasting in the middle of the inaugural Mid-Market Dealmaker Symposium here at the Ritz-Carlton in Miami Beach. Next year, we hope you can join us. We're having a lot of fun here, and tonight we'll have our big dinner at the Red Steakhouse. And we continue to do stuff, but the main focus here is the What's the Deal with Deals. We have 5 panels of industry experts. Each are going to be a half hour, so it's a 2.5 hour total. It's going to be a lot of information, but it's really going to be a lot of fun and a lot of interesting conversation. So the idea for these panels are not going to be a lot of people kind of pontificating and telling you the way it should be or this. It's going to be real people that do deals that are here, and they're going to tell you what really is going on, what's the climate in lending, in mergers, how the pandemic affected things. We're going to talk to some industry leaders too, and so we're looking forward to a lot of fun and action-packed. So I'm going to turn over to my partner in putting this conference together, along with Tony Nashar from Polsinelli, Aaron Hammer of Horwood Marcus, and would like Aaron to moderate the first panel.
Well done. Good morning, everybody. It's nice to see so many familiar faces live in the audience, and to the rest of the world who we're broadcasting live on the internet now. Thanks for joining us. We are going to have compressed panels today. There'll be 5. We'll go from 11 to 1:30. This shouldn't be a talking heads type presentation. Hopefully it'll be interactive. You can ask questions. We want to get in and out of here so that everyone can enjoy the beach at 1:30. Hopefully the weather will be rock solid. And let's kick it off. First program is What's the Deal with Deals, Parts 1. We have several M&A experts here. They're going to talk about the state of the M&A acquisition markets. And I'm going to let, in the interest of time, I'm going to let each of the panelists introduce themselves, and then I'll kick it off with the first question. John.
Great. Thanks, Tom and Aaron, for putting this together. It's phenomenal. First annual, hopefully many others, and thank you for having me. My name is John Bintz. I'm a managing director and partner at Valuation Research Corporation, and I manage the Chicago office. We're a full-service valuation firm. A lot of our business is in the M&A activity and a lot of deals, so hopefully I'll be able to provide some insight what's going on.
Hi, I'm Jeff Hechtman. I'm at Horwood Marcus in Burke. I spend my time practicing primarily in the deal world, M&A, private equity, and finance. And thank you to Tom, Aaron, and the sponsors for having me on the program.
Thank you. Tom Goldblatt, Managing Partner, Ravinia Capital. Ravinia Capital is a investment bank. We focus mostly on sell-side M&A of both healthy and privately held companies and distressed transactions.
David Gordon from ARC. I'm supposed to be that guy John Olson, but unfortunately he's under the weather.
Your wallet just got bigger.
But we buy distressed debt, invest in some distressed companies from time to time, both U.S. and abroad, and also get involved with some financing transactions as well.
Awesome. Thank you, guys. Thank you for participating. And I'm excited to hear what's the deal with deals. Usually Tom Goldblatt's asking that question, so it's a privilege to serve in this role that was initiated by Ravinia Capital. David, what's the deal with deals? What have you been seeing in the last 24 months? What's the activity like right now? What's your focus?
I got to say, for distressed, it's been a very good 2022 for us. 2021 and 2022 were our 2020 and 2021 were our 2 best years. We are probably about 40-50% real estate focused. We're also involved in the hospitality space. With COVID, obviously a lot of hotels took a huge hit. During that time, we started a hospitality SPAC. We expect that to continue to grow that space over the next year. We're seeing a lot more opportunities in the country than we did before from a pricing standpoint. I think the only thing I'm scared about going into next year is climbing interest rates and how that'll affect pricing moving forward.
Awesome. Thanks.
Thank you.
What are you seeing, Tom?
Well, I think you can pull up a chart here we had created. Yep. So I think we're seeing with a lot of people that after things slowed down for the first half or the second quarter for sure, and third part of 2020 with the pandemic, things have really been, just as you can see in the public market, tons of M&A, and you can see here that the pricing is really high. I actually had this chart made by PitchBook, and I had them go back and redo it because I just couldn't believe the multiples that they're showing are that high. But that's kind of where the market is. So it's a frothy market. I would say on the distress side, disagreeing some, is that it's been very slow on the distress. We're doing some, 363 bankruptcy auction, but overall, bankruptcies right now this quarter are at a 36-year low. So it's the government support and other reasons have really kept that. People thought it would be busier, but it's been slower. So I'll let Jeff talk.
Sure. We've had our best transactional year ever. There's an acceleration of a trend towards acquisitions of asset-light businesses, branded businesses, service businesses in particular. Multiples have been high. Banks have been generous. Hopefully that continues, but when you look at the numbers, it's hard to be that optimistic. Deal work was actually so busy this year that for the first time since the product was invented, rep and warranty coverage, the industry ran out of capacity from what had been set aside. And so deals in the fourth quarter, if you wanted an indemnity policy and you weren't doing a huge deal, it was exceptionally challenging to get. That'll re-up all the allocations January 1, but just as a sign of how much deal activity there was, they ran out of capacity.
John, you're our valuation expert here. What do these high valuations mean to you?
Yeah, they're certainly here. High valuations, there's lots of dry powder. If you look back in 2009, the Fed's balance sheet was $1 trillion. Today it's approaching $9 trillion. So they've flooded the market with cash. Private equity has cash, corporations have cash, and that cash is chasing deals. That cash is chasing M&A. So prices are going to continue to go up. There's some scarcity value out there. Tech companies, technology companies, healthcare companies, biotech, those seem to be getting the higher valuations and the higher purchase multiples. But it's kind of across the board, not only in private equity, but also in venture capital as well. So it's kind of across the board. Lots of dry powder. Private equity has about $1 trillion or so. Valuations are high, deal activity is high. Interest rates. That is one of the components that is driving the activity because it's so low. If you look at inflation now is 5.5%. The 10-year bond yields 1.5, so you got a negative real interest rate of -4%. When in history is real rates -4. So those are the ton of money, and I see the deal activity to continue until there is a significant increase in interest rates, whether it's gradual or whether it's really quick. I think the Fed today has a meeting and they'll make some decision on the tapering and how they're going to go forward with interest rates going up.
It does seem like they're starting to get scared. It seemed that they were playing it cool, and they're now going to accelerate that. Getting rid of the additional buying of the bonds and everything, and then I don't know. I think people are going to be surprised. It might be 2 to 4 interest rate rises in this year, and I agree, it's going to shock the market.
It's going to shock a little bit. I think there's anticipation. The public market, the public equity markets, including the debt markets, kind of understand that it's happening. It's just how quick is it going to happen and how dramatic will it be? Obviously, one of the components in interest rates is inflation. So you have deflationary forces and you have inflationary forces that are always affecting interest rates. On the inflationary side, the argument is, okay, is the inflation that we have now temporary or is it permanent? The things that I have read suggest that about 25% of the inputs of inflation are temporary. So that would be labor prices, things of that nature, and 75% are permanent. So we'll see how that plays out. We won't know until we get further along the timeline.
I think the labor prices is the hardest to come down. I mean,
it is. That's the permanent aspect, and it's very difficult to. Okay, now you're not going to get $14 an hour. when you just had 16. That's
Right.
difficult to
Yeah,
do.
very.
So I think that's part of the permanency.
I'm not taking
Yeah,
a pay
I
cut,
think
yeah.
I think the real reckoning is going to come as a result of all this frothiness. In particular, the senior lenders lent off covenants that were real aggressive, and I think 2022, if businesses don't perform, which I think there's a likelihood that a lot of businesses aren't going to hit these aggressive projections because of supply shortages, labor market issues. Come early 2022, you're going to have a lot of companies reporting covenant defaults, and that's the first time that I think there's going to be a systematic reaction to what's going on in the marketplace. So I think 2022 stays robust, and that's the first kind of point in time where I see stop and pause.
Fork in the road a little
Yeah.
bit.
Yeah, that's interesting. And on the deflationary side of things, there's inflation, there's deflation. To me, there's a lot of permanent deflationary forces that are in play. The first is technology. You grab these phones and look at what it's done to the supply chain of people's lives. You know, it's taken out a lot of costs. If you look at what's apps on your phone, it's destroyed a lot of businesses over the last 10, 15 years. These smartphones are amazing. Also, you have a global labor force. So the shirts and clothes that we're probably wearing now were probably made somewhere in Southeast Asia and not in North Carolina or South Carolina. So that's a deflationary effect, as well as demographics. You have low fertility rates in the Western civilizations. In the United States, I think the fertility rate is 1.7. Japan's 1.4. So unless you have 2.0, you will not maintain an economy in a country. You will have deflationary forces. So those are forces on the deflationary side, as well as the printing of money and spending money, et cetera, on the inflationary side. We'll see what wins out over time.
David, you have some thoughts on this?
I'm just listening at the moment, actually.
Yeah.
So my business is a little different than the M&A space than most of you guys are used to. You know, I'm looking at the hard asset side of the business. I still think, to your point, interest rate climbing are going to be extremely exhausting next year. But with the amount of money out there, I think you said $9 trillion with the private equity companies, there's a ton of money to be spent, a ton. And with the bond market being what it is, I'm a bond guy. I worked at Morgan Stanley till 2008, till the world blew up. And seeing where the bond market is now and how low yields are compared to even what it was 4 or 5 years ago, people are chasing deals. And it blows my mind what I'm seeing REITs trade at right now, multifamily, commercial real estate, and deals in general on deals that you've never seen on the M&A space before as well. When tech companies are selling, and that's one thing I don't understand, at 100 times a multiple when they are in a negative cash flow position. And I don't see that stopping in these Bitcoins and other businesses that I don't understand. Maybe you guys understand them a lot more than me. And a normal business would be selling 10 years ago at a 5 multiple, is now selling at a 10 multiple. There's just too much money out there right now.
Certainly a lot of froth.
I like how the distressed guy here looks at asset values.
So I
He
think
wants to
there's-
know what he's buying. What's that
I think
worth?
there's another force that's going to come into effect at the upper end of the market. You're going to, in the back half of 2022, you're going to see the hold periods start to run for some of the early SPACs. And you're going to see what the results are when those who had the SPACs and those who sold into them, when they liquidate. The SPAC market is reacted negatively, indicating that a real learning curve for people, that one of the more important things in SPACs is the ability to trade through for the full 18 months. And so the SPACs that are happening now are almost all north of $1 billion and even climbing, because you need to maintain trading volume or the SPAC collapses. And
Turnover of the assets,
no, you literally need people to trade the stock.
trading of the stock
the
itself.
stock. And so there are a number of SPACs below that $1 billion threshold, and their trading restrictions on the founders and those who sponsored the SPAC are going to wear off starting back half of 22, going into 23. That'll have a significant impact on big sponsors who drive a huge portion of the M&A market, and depending on what happens, could create go private transactions, could create all kinds of refinancing transactions, could limit exit avenues.
But when am I going to get back in the game? That's all I care about.
I got to say, to your point, we went live with our SPAC in January this year. We have a hospitality SPAC. And I agree and I disagree with certain points you made. But one of the things that we've seen, yes, you have to spend a certain amount of money in 18 months. I get that. And our hospitality is very similar to the one Trump just launched very recently. Trump launched his, I think, about a month ago, if you remember. Whether you're a Trump supporter or not has nothing to do with this conversation. But just from the marketing standpoint, never made an acquisition yet. The stock went up 1,100% in 4 or 5 days, if I remember correctly. It might be a little bit off. Mine has not even gone close to that. It's made an acquisition yet. It's gone up 0. Same exact focus, actually, from a doc perspective. But one of the things you said about managers spending money on that and also getting the right private equity companies to invest in it is the pipe deals you're seeing on these with companies that acquisitions are happening, and we're doing a pipe behind our SPAC that's raised some money.
Why don't you explain what a pipe is? Maybe not everybody.
It's really taking, to dumb it down, which I think is probably the best way to do it.
For the dummies in the room.
Including myself. But it's really getting a handful of large investors to lend money to the actual SPAC. I'm using a SPAC as a term. It doesn't only have to be a SPAC, but at the original acquisition cost, knowing what's going to happen in the future. It creates more of a lending structure, a loan-to-own structure, I guess you could say, is the best way I would explain it.
And the PIPE acronym stands for Private Investment in Public Entity.
Private investment.
There you go.
Excuse me, sorry.
Well, I think I'm going to shift the conversation a little because I think that the SPACs and that's always to me has meant a lot of frothiness. But I was finding with deals this year, and I haven't heard this talked about a lot, but it was kind of hard. Like a lot of the companies either did much better during the last year and a half because of the pandemic in one way. People were buying their products more. There were shortages creating inflation, or actually worse. But I'm finding actually selling healthy companies, we're kind of having trouble deciding what's the price going to be based off. Should it be this year's EBITDA? Should it be an average? And then coming to a solution too of it. Can this deal? Should it be somewhat of an earn-out? Things like that. But there are these issues as you get it close to the closing because these times are so extraordinary and people don't know if they're going to continue. So is the company worth what they did in 21 or is it worth what they did in 19?
Just give us an example. How have you seen that play out?
Well, what we've seen in a number of our acquisitions is a number of the targets, EBITDA spiked in 2021. And so there's a real question as to whether what had been a steady growth in earnings like this that shifted up, is that a permanent paradigm shift or is that pandemic related, and how do you back out the impact in the pandemic?
Seems tied to inflation too, right?
Well, yeah, and the difficulty is when you're setting these things up, what was an anomaly and what wasn't.
I think one aspect to the answering that question is technology. How much technology does that company have is its basis for its revenues and its businesses? We've seen tech companies since September 2020, which was kind of the beginning, I think, of all this activity in M&A, go up 5 turns. So if it was selling at an 8 multiple, now it's at a 13. I saw one tech company, reoccurring.
It's like revenues. Condos where I live here in South Beach.
Right. Reoccurring revenues, software, technology traded at 25 times EBITDA. So E's got to grow into P, and you hope that E grows into P, and you hope that isn't a one-off year because of COVID. But if you work on a computer, if you have a computer, you're probably in a pretty good position. It's technology-based.
I think that explains a lot of this that a lot of these high multiples are for these tech companies. Tech is infinitely scalable. But whereas the companies that are more bread and butter and make manufacturing and they have certain cash flow, like that was steady, you're really not seeing these type of multiples in the deals under 250 million.
Can we see the next slide, just in case someone wants to talk about it? Let me ask a final question, and then we can solicit some from the audience. We've got about 9 minutes left. When the music stops, how do we see the music stopping? Is it going to stop like it stopped in 2008? or is it going to be more gradual, like we saw in 2000, 2001, 2002, and sort of, what are going to be the triggering points of that?
I'll take that first. To me, it's a great question. That's the million-dollar question. I don't have that answer. I think interest rates are a big component of that. I think debt is a big component of that, but the market will decide when that occurs, and probably the credit markets probably turn off first. They usually have a lead. That's what happened in 07, 8, and 9. I think July of 07 was the first deal that says, no, we're not going to do that anymore. 6 months later, the stock market went down. So the credit markets usually lead in interest rates, if it goes up fast with the slope of the interest rates going up, gradual or fast, that to me is a big component.
Yeah, I don't see it collapsing. I see it as a taper. It could be an extended taper, but one of the things that we learned out of the pandemic is that the government learned a little bit about banks. And so when the pandemic set in and the Fed eased capital adequacy, had they not done that, tons of businesses would have imploded, and they made money flow and kept it flowing, and that prevented a recurrence of what happened in 2008, which showed, interestingly enough, that the government actually has a little bit of a capacity to
I was
learn.
wondering, like the PPP program, that came around really fast. Do they have that on a shelf?
I think you got to look. I think you got to look at it a little bit differently. I think what you take from that is the government learned if you don't pay attention first to the banks, that the other stuff's not going to matter. And so right after the pandemic set in and the business world shut down, the Fed stepped in, eased with respect to the banks, and then PPP and the other stuff happened because in 2008, the lenders were forced to act. And so the government took that out of the equation.
From a regulatory perspective, it just couldn't be done in time.
They had bad loans, and the government's rules were going to make
Forced a
them
reconciliation, yeah.
I think that M&A is going to continue to be strong for a while. There's obviously so much overhang of money and private equity, and company have cash on the bank. It will continue like that until it doesn't. And so when is it? I think if you look at history, whether you're looking at the 29 stock market, the 2008, you look back to the tulip bulb boom, it always ends suddenly. So people always think it's going to be a deflate. But once people think that these inflated prices aren't there, the whole world turns from optimism to pessimism, and that's when everything looks different. But that can happen. It could happen this afternoon, or it could happen in 10 years.
Yeah, I think there are actually a couple other mitigating forces that didn't exist in the past that are going to soften the blow a little bit. There's a proliferation of non-regulated lenders, private funds, et cetera, who aren't subject to the same restrictions and requirements. They fill a void in the marketplace. I think starting in 2023, those who finance creatively are going to have a huge number of opportunities because where the lenders can't continue with them, private lenders have the ability to be creative, to do alternate structures, to take pieces, warrants and equity. I think those all mitigate. They give people a source of funds that hadn't existed in past downturns.
Anyone here who's a non-traditional lender, you want to raise your hands? I got one. He's a client of mine. I got 2 there, 3 there. Is what Mr. Hechtman just said, are you banking on it? You think that's a reasonable probability that the banks are going to want out of tougher credits and you guys will be able to step in?
I would say it kind of depends on the business size. So, our strata will look at is probably the lower middle market. I think traditionally those are the companies that more traditional lenders are going to feel comfortable taking more larger firms more opportunities. And I think, in my opinion, that of course I hope in the frame that's more in 2020.
That was Tim Saratella, Belvedere Capital. Thanks for being here. Any other questions from the audience? Let's see. What do we have of our M&A?
I did want to say what I think that people don't. A lot of the family businesses and small, they were really busy operating. I've never seen, and in fact, sometimes when we're selling a company, we had some of the strategic buyers say, we're just dealing with our own shortages and stuff. So I think a lot of these companies, when the dust settles, are going to put themselves up for the market. I think that, you'd be kind of, if you're thinking of exiting over the next couple of years, you'd be crazy not to exit really soon when the market is this good.
And low interest rates are still around.
Stacy, you had a question?
Yeah, thanks. So, Tom, can we go back to the prior
You want to
slide?
introduce yourself real fast?
Oh, Stacy Schachter with Vine Investments. So, Tom, you talked about this multiple.
Yep.
Take out your phone, look up S&P 500 PE ratio, and you're going to see it's today 29.13. The mean is 15. So you have these enormous valuations on the public side, which drives private valuations. You can take a look at PE firms like Carlyle, who now have, traditionally, private equity might take a public company, take it private in order to build value.
Yeah.
Now the exact opposite is happening. So Carlyle has about a third, I think, of their portfolio is now public, which is a pretty high number on the PE side. And also when we talked about Fed rates, yes, you should expect them to go up, but not until the tapering program is over. And that probably won't happen until Q2 of next year. So by Q3, we should begin to see interest rate increases, but by most estimates, we're going to see a 25 bip, a 25 bip, and then maybe 2 more 25 bips. So over a period of a year and a half, maybe 1%. And I don't know if that's really enough to drive down valuations. So with all the SPACs and everything continuing, I don't see a potentially hard stop to any of this. And maybe you'll get some trickling, but the government, the consumers, for example, still have 2.3 trillion of savings. And as long as the supply chain can be fixed, and we're beginning to see some of that, that's going to continue to drive the economy. And inflation will come down, but probably still be even next year around 4 to 4.5%.
Aaron, I've got 2 more data points that I wanted to share. First of all, we do a lot of solvency opinions for dividend recaps, and there's a lot of them. So a dividend recap is a company, usually a private equity-backed company. They'll recapitalize the balance sheet and they'll take out a dividend and pay the shareholders. We're seeing a lot of that, so interest rates relatively low. And the second thing I wanted to mention is the supply side of businesses that are to be sold. The demand is there. We know there's a lot of money, but baby boomers are selling their businesses, the high valuations they're getting, tax considerations, and they want liquidity events. And maybe their children aren't going into the family business. So there is still definitely a good size of supply of companies to be sold as well.
Awesome. That was great. Thanks for participating. To our guests, we're going to switch up the panel now.
Yep.